Hey guys, and welcome back to another video. Today I'm going to be speaking about risk management. Now, your first thought must be how to protect your capital and make your trading as safe as possible. Now you're in luck because there is one safe, sure rule, and the trader who will follow it and never deviate from it will always keep his money and come out ahead at the end of every single trading year. This rule is simple. Always have a stop out level that is not larger than 5% of your overall balance. That means if you start with $1,000, you should not risk more than $50 on your first trade. And if you use asymmetric risk settings on your trades, your reward will always be larger than your risk. Meaning you risk 1, your reward is 2, preferably 3+. Now, you can always find new trading opportunities to make profits on, just as long as you have capital to operate with. Taking heavy losses in the beginning endangers your capital and impairs your judgment. So, you need to trade in such a way that you will not be disturbed mentally by a loss. And the only way to do that is to have risk controls, meaning definite stop out levels and definite overall risks on every single trade. So, while we're speaking about risk, I want to speak about overtrading a little bit. Now, history repeats itself because of the weakness of human nature. The greed for quick fortunes has cost the public countless millions and billions of dollars. Now, every experienced trader knows that overtrading is his greatest weakness, but he continues to allow this weakness to be his ruin. There must be a cure for this greatest weakness in trading. And yes, there is one, and that cure is called a stop-loss order followed by risk controls. Stop losses and risk controls are the cure for this disease we call overtrading, or better said, gambling. So, in 2 points, I'll summarize the basic cure for this disease. 1. Always have and use stop losses and never remove them. What I mean by this is always have a stop out area and never ever deviate from this area, never remove this area, never change this area. 2. Control your risk by not allowing yourself to risk more than 5% of your overall equity balance at one time. So, let's continue. Risk controls. Here's where the important stuff is. The markets are no place to look for excitement. We are here to make money, so we need to be 100% serious and devoted to earning. And before we can earn, we need to protect what we have. Here's how to set up risk controls. First, your trading account, your leverage on that trading account should be 1 to 50. If your balance is 1,000 or above, put it 1 to 50. If your balance is below 1,000, I still would recommend 1 to 50 because that wouldn't allow you to increase your trading. So let's just keep it. Set your leverage 1 to 50 regardless of your balance. 100, 200, 500, 1,000, I don't care, 1 to 50. If you go above 10K, if your balance is above 10K, then put 1 to 20. That's totally cool. 1 to 20 above 10K, anything under 10K, 1 to 50. Don't risk more than 5% at any given time. If your SL is too tight, then lower your position size. Meaning, if you're using the risk management calculator and you put a position of 0.01 and it tells you that your stop loss should be 20 pips, well, then cut your position by 80%, meaning 0.02, and you will get much more allowance on your actual stop loss. 2. Correspond with Dennis, that's me, about your trades, your balance, your goals, and everything else. Speak to me, guys. You need to ask me questions, and I have a lot to offer. So correspond with me as much as you can. If your equity drops by 10%, trade as if you lost 20%. This way you will trade smaller at your natural periods of losing. Let me say this again. If you lose 10% of your equity, trade as if you lost double. Okay? That means you need to lower your position size, which means you only have 80% of your actual deposit available now. You get it, right? If you don't, talk to me about this. Okay, let's talk about something very simple, and that's the big concept that comes with risk management. There must be never any objection in taking or closing a loss. but there must always be good reasons before you can permit yourself to close out a profit. So let me read this again, and you read it again and again and again. Pause this video and just make sure you have this clearly implanted in your mind. There must be never any objection in taking a loss or closing out a trade that's in a loss. No objections. But there always must be a good reason before you can close out a profit. Make sure that you follow this basic rule. Now, I want to talk about the dangers in trading caused by human nature. A couple of points that are going to help you understand all of this a little bit better. 1. Fear. Fearful of active profit and the trader closes too soon. I'm sure this happened to you many times. You open a trade, you say there's your profit target, but you start winning some money and you start feeling uncomfortable because you fear that the market will reverse and your profits will diminish, and you close your trade too soon, thus not allowing it to work in its full potential. 2. Hope. Hopeful of a change and the trader holds on to a loss too long. There's hope. Many people hope. They open Euro USD sell and price goes up, 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 and they're hoping it's going to turn around, so they remove their SL, they ignore their stop out level, and price keeps going up, and eventually they take a 25, 35, 50 or even 80 or even 100% loss on a trade that they should have taken a 3 to 4% loss. 3. Lack of confidence in one's own judgment. You need to have confidence in your own abilities and your own judgment. If you don't, then there is no reason for anybody else to have confidence in you. So the way you gain confidence is from practicing and learning and improving, and of course following rules. The only way you can develop confidence in my trading system and my rules is by using it. Okay? I'm not pulling stuff out of my ass here. This stuff works. Everything I speak about works. Everything I try and teach somebody, I've actually tested and used in the markets. Not once, not twice, but countless times. And of course, I teach it to you because I know it works. 4. Not doing your own thinking. This is very dangerous. You need to make your own judgments and your own thinking. So when I release a trade and I say gold's gonna go up, you need to review it for yourself, okay? You need to make sure that you do your own thinking on this trade idea. 5. Swearing alliance to either the bull or the bear side. Okay, many people do this. Recently I spoke to a guy who sent me a message and told me that he was a gold trader. I sent him the article that I released recently on gold, and he says, you wouldn't believe this, but I never sold gold. I would always buy it. Ironically, this guy doesn't trade anymore either, but I'm not dissing in any way, but what I'm saying here is you can't just be one-sided on a trade or an asset. Your concern lies in making money, and that's bears and bulls. 6. Laziness prevents a trader from keeping posted to market movement and news. You can't be lazy, guys, in the markets. If you don't have too much time to analyze everything, you can always find a few minutes just to check the key current news, what's going on in the markets. There are ways of doing this, and I will, of course, go over that in the fundamental review that I'm about to release in the next couple of weeks. Finally, 7. Failing to stick to the facts. Facts is what we want, okay? Not mythological creatures and wishes. The only thing we're thinking about is facts. And the final one, 8. Believing in what it pleases the trader to believe. This is a big mistake because most people just want to believe in what feels good, you know, so they stick with that. And that's why they lose a lot. So these 8 points, check them out, take a screenshot, read them. Think of times that you failed, where this human nature, you know, caused you to lose. Basically fear when you had profits closing too soon, when you were hoping price would turn around, when you lacked confidence in your own judgment, when you were not doing your own thinking. All of these things, I'm sure one of these things can apply to your losses right now or in the past, so check them out. Okay, risk management. Let's talk a little bit more about it. I always say that risk management must be simple as a short sentence. I will not risk more than 3% of my overall equity at any given time. Now, the rest is up to you to follow and obey. That sentence is my risk management system. It tells me I will not risk more than this much, and then the rest is up to me to follow and obey. What I mean by follow is follow my word. Guys, you need to stick to your own word. You can't just decide one day, oh, I'm going to just open this trade because, you know, there's huge potential on it. fuck the potential. You're here to make money, so you need to be serious. You need to be professional. You're trading against some of the best traders in the world, okay? So you need to get their money. And the only way to do that is, well, controlling your risks. If you want to be a professional trader and earn money in the markets, you must apply and follow this basic sentence. For example, I am happy to risk a maximum of 5%. Someone else would be happy with 3, and someone else with 1. For the last 12 months. For the sake of learning, I want anyone who started trading in the last 12 months to not risk more than 1%. Anyone who joined Pips Matter in the last 6 months, do the same. For everyone else, you consult me on your account, we do a risk management plan, and then we basically apply it on every single trade you take. This is the best way I can help you. So consult me. If you've been with us for 6 months, talk to me. Even if you haven't, talk to me. Let's make a risk management plan together. Okay, so what you can control in trading and what you can't. Here's what you can't control. You can't control market movement. You can't control how the news will affect price. You can't control the outcome of your trade. But here's what you can control. You can control when you trade, when not to trade, what to trade, when to exit your trade, your position size, how much to risk, your emotions of the outcome of the trade, your learning process, and so much more. As you see, the key things you can't control: market movement, how news affects price, and the outcome of your trade. These things you can. But there is so much more that you can't control. That's why being successful in the market is all up to you. Okay? Anyway, let's summarize this video quickly. Risk management is essential because there is no way that you will win 100% of your trade ideas. Get that through your head right now. You will lose, and you will lose many of your trade ideas. In fact, thousands of trades every single year that you say will go this way or that way will be completely wrong. So you will need to use risk management, otherwise you won't be here for long. Attached to this lesson is a basic example of an account together with how losses will affect your account. It also goes over a little bit about the profit side, but I just want you to take a look at it and see how it would work. I will show you a basic example of it now. Let's do that actually right now. Here it is. So how losses impact an account. A 10% loss requires an 11% gain just to be break-even. A 25% loss requires a 33% gain to be break-even. If you lose 50% of your account, you need to earn 100% back just to be break-even. And guys, if you go down to 80%, you need to make 500% back just to be break-even. Imagine all that hard work. So that's insane, and that's what I don't want you to do. So this will be attached just so you can look at it, even print it out if you want. Take it, stick it on your desk or on the wall or maybe on a board that you might have, just so you can mentally see this and know that if you go down 80%, you need to make 500% back. Now, I released plenty of questions that you should ask yourself before you open a trade. I beg of you, please follow the process, as it will improve you as a trader. One of the best questions to ask before you open a trade is, how do I know I am right? This is the first question I will always ask you. How do you know you're right in this trade idea? The second question I'll ask you is the flip side of your trade. Tell me the reasons it could go against you, both technical and fundamental. Now, my job is to teach you to trade professionally. Your job is to obey and follow my rules and practices. If you do, I promise you will be rewarded. If you don't, you will waste your time and money, and I certainly hope you don't want to waste these two precious assets you must hold dear to yourself. That's all I've got for you guys. I want to tell you a big thanks for watching this video. If you have any questions, you can ask me on Viber, Dennis, or Skype, Dennis-Matters, and email dennis@pipsmatter.com. Thanks for watching this video. I wish you a super trading day, and I'll see you later on. Bye.